everyone, we are from Group 4 that consists of me, Dinny, Firvidiani, and my friend Rofifah, Rizda. We like to present to you all our presentations about economy or market analysis. Next, this chapter begins from discussions of fundamental security analysis by considering the economy and the market. This is the first step in the top-down approach because of the overall influence of the economic or market in impacting stock returns. The top-down approach to fundamental security analysis has three steps that are: analyze the economy market, focus on sector or industry that appear attractive, and analyze and value individual companies. Next, assessing the economy. A basic measure of the economy is gross domestic product or GDP, defined as the market value of final goods and services produced by an economy for some time period, typically a year. It consists of the sum of consumption spending, investment spending, government spending, and net export. Consumption now comprises about 70% or more of GDP. GDP numbers are prepared quarterly and realized a few weeks following the end of the quarter. This number constitutes a basic measure of the economic health and strength of the economy. Next, we're talking about the business cycle. The business cycle reflects movement in economic activity as a whole, which is comprised of many diverse parts. The diversity of the parts ensures that the business cycle are virtually unique with no two parts identical. However, cycles do have a common framework, with a beginning that starts from a true, a peak, and an ending or a new truth. Thus, economic activity start in the depressed conditions, build up in the expansionary phase, and end in the downturn, only to start again. The word true is used to indicate when the economy has hit bottom. The period from a peak to a true is a recession. The period from a true to a peak is expansion. Composite Economic Index. Series of leading, consistent, and lagging indicators of economic activity to assess the status of the business cycle. The composite indices are used to indicate peaks and troughs in the business cycle. And now, Indonesia officially recessions after the economy contracted for two consecutive quarters. In the third quarter of 2020, the economy was minus 3.49%, while in the previous quarter it was minus 5.32%. Next slide. Stock price tend to lead the economy. Historically, the most sensitive indicator, stock prices consistently turn before the economy. And how reliable is the relationship? The ability of the market to predict recovery is much better than its ability to predict recession. And next slide. In this slide, we're talking about the insight from the yield curve. The yield curve relates the relationship between bond yields and time, holding the issuer constant, and its effect shows how interest rates vary across time on any given day. It should contain valuable information because it reflects bond traders' view about the future of the economy. Several studies suggest that the yield curve is very useful in making economic forecasts. Professional traders and many managers use the yield curve as an indicator of how the Fed is managing the economy. There are several types of yield curve. A steepening yield curve suggests that economy is accelerating in terms of activity as monetary policy stimulates the economy. When the yield curve becomes more flat, it suggests the economic activity is slowing down. An inverted yield curve carries an ominous message. It may imply a recession. And next slide. We're talking about some factors affecting the economy. In here, I will talking about interest rate. Rates, higher rates discourage borrowing and spending, decrease stock prices, interest rate affected by inflation, exchange rate, demand for for funds or supply of funds, it can borrowing or saving, and also short-term rate that set by Canada, Bank of Canada, and etc. The next factor will be discussed by my friends Rofifah Rizda. Time is yours.
Okay, the next factors affecting the economic is exchange rate. Exchange rates determined by supply and demand for the currency, affected by first inflation differential, second interest rate differential, third current account balance, and the performance of economy, and the last one risk. And for the next effect is inflation. Inflation is high inflation, reduced real return on investment, might lead to higher interest rates and can increase risk in economic and inflation related to output GAP. This is like difference between potential output of economy and current level. And the last one is governmental policies. Government policies, uh, there are two kinds of government policies. First, monetary policy and fiscal policy. For monetary policy is an effort to achieve sustainable economic growth while maintaining price stability. And the last one, fiscal policy. Fiscal policy is an economic policy carried out by the government to manage and direct economic conditions in a better directions by government revenue and expenditure. And for main effect of fiscal policy is spending, tax, deficit or surplus, and automatic stabilizers. Stock prices and the economic. This is the formula to calculate of stock prices and the economic. And stock prices affected by economic factor through effect on current and future profitability and effect on required returns such as interest rates, inflation, and risk. Predictions of economy can help predict change in the companies of stock prices. And the next is following the overall stock market. Overall market can be valued in the same ways as individual stock like DDM or based on justified ratio, notoriously hard to predict futures level of market. This is related to stock investment affected immensely by general market movement and general market movement linked to economic changes. To estimate market earnings, need to estimate GDP, and the second estimate corporate sales, and the third estimate corporate profit before tax, and the last one estimate corporate profit after tax. And the last objective is two key market variables. First, price earnings ratio. Level of index divided by a measure of aggregate earnings of those firms and compare today's level to historic norms to see if market is over. And the last one is dividend yield. Dividend yield is compare today's level to historic norm to see if market is over, like to see low yield or under high yield value. And normal sometimes consider approximum 2.5%. I think that's all from group before. Thank you.